in terms of your YOY and month on month to see that what are what are the items which are actually kind of disinflating. So you can see that on a month on month basis, there's hardly any items which are disinflating, right? So there are only very few items like your oils and fats and vegetables and fruits which are showing that. But most of the items are actually going up sequentially, and of course they're all quite high on a YOY basis. Now vegetables is of course a very volatile item, obviously that cannot be the basis for having a positive view on inflation. I think cereals inflation is the key worry for India to kind of control food inflation and overall inflation. The government has to gain some control over cereals inflation. Okay, that's as far as food is concerned. Now, when you look at the core CPI, which is basically after stripping out food and fuel, how does it look basically? So again, core CPI, you can kind of split it into goods and services. So obviously core goods CPI is something which went up after the pandemic, and then it started coming down. Again, this is somewhat similar to what other countries are facing. It's similar to what the US is also facing. So there was a lot of excess demand for goods, so goods prices went up. Now the demand is shifting to services. So what you're seeing is goods inflation coming off, but it's still fairly high, and then services inflation is kind of creeping up. So one positive for goods inflation is that there's a lot of those supply chain bottlenecks which we have been grappling with, say, for the last 12 to 18 months. Those bottlenecks seem to be easing, so that should help on the goods inflation side. On services inflation, of course, you have things like housing and education. Probably these were all kind of depressed during the pandemic, and now they're all going up. So what you will see is an interplay where goods inflation is slowing down, but the services demand and services prices going up. So net what this could mean is that maybe there is not much relief. So you can possibly say that core inflation won't accelerate from here, but probably it won't come down very sharply also. It can continue to remain a bit sticky. So one way of looking at underlying inflation is to use some metrics. Obviously core inflation is one of those metrics, but core inflation is constructed by excluding certain items arbitrarily. So there are other statistical means of doing it, like a trim mean CPI or a sticky price CPI. So if you look at those metrics, they are actually quite high. Essentially, it is not just headline inflation which is high in India, but you have the statistical measures of underlying inflation, even they are quite high. So in that sense, I think RBI is quite right to be worried about high inflation. It is not just due to food or fuel. There is a breadth of high inflation within the CPI basket, and that is why they are worried about it. In terms of estimates, of course, RBI expects that inflation will come down next year. That's fourth quarter of this fiscal Jan-March, and then subsequently it will come down to below 6%. So we think the Jan-March quarter inflation can actually be higher than RBI's estimate. So that is a risk to the forecast. But going into next year, broadly, we have similar forecasts. So the whole of next year, I think RBI is expecting 5.3% inflation from 6.7 this year. Our estimate is broadly similar. So as of now, it looks like the period of high inflation should be behind us as we go into next year. Of course, again, this is all basis assumption that oil price comes down or at least stays at current levels. Okay, now shifting to growth. Again, this is a quick snapshot of what we got in Q1 GDP data. So again, if you look at the right-hand side, this just compares with the first quarter of FY20. So the pre-pandemic quarter or the pre-pandemic year, how much the GDP components have grown from there. So that gives a good idea of what are the leaders and laggards. So clearly one laggard is your trade, hotels, transport and communication sub-segment, which is like 15% still below the pre-pandemic benchmark. So clearly these are the services, contact-heavy services segments, which still haven't recovered. So on the one hand, then it means that actually there is a lot of scope for these services to catch up, for this growth to kind of pick up going forward. But also you have to wonder whether some of that growth is permanently lost. In terms of this is basically GVA. So in terms of the GDP components, again, your exports have done well. But if you look at government consumption and investment, they are actually showing quite anemic growth over the pre-pandemic period. So this was the headline. So of course, if you look at some of the internals of GDP data, they weren't so bad. So again, if I strip out the government spending and look at private demand, that was actually fairly strong. So the government spending growth was quite weak in Q1, and going forward that should pick up, so that should support GDP growth. But the private domestic demand on its own, that was fairly strong. Nominal GDP growth is of course very, very strong, and that has an implication for government finances. Gross fixed capital formation as a percent of GDP, which is basically your investment as a percent of GDP, that has also been going up. And one of the reasons is that the capacity utilization in the manufacturing segment has gone up. So there is RBI data which shows that it's around 75%, and that is close to previous peaks. So it kind of tells that maybe companies are, or rather a lot of sectors are hitting their capacity limits, and that would automatically mean that more investment has to come to expand the capacities. So this was the official data, which of course was a bit weak compared to estimates. But if you look at the high frequency data, those data points have been actually quite strong. So whether you look at nominal variables like exports, non-food credit, or GST collections, or you look at some of those volume indicators and you average them and see auto sales, for example, those things are actually showing quite strong momentum. So of course, this is a bit of a puzzle in India, that your official statistics maybe are not fully capturing in a perfect way what is happening in the economy. This is particularly a problem with the index of industrial production. This seems to be a problem with the GDP data also. So maybe one shouldn't get too kind of downbeat over growth prospects. When I look at the high frequency data, it does look quite good. Of course, one of the worries is that whether this consumption or this kind of activity is all very skewed, right? So only you have this talk of K-shaped recovery, right? So obviously the bottom income groups are not kind of in a good situation, and therefore their consumption is not picking up. But even there, maybe there are some signs that things are picking up. So you have these diesel sales, for example, doing well, and that could be a rural proxy. Your tractor sales doing well. Your demand for MNREG as employment, which is again an imperfect proxy, right? So if there are more rural jobs available, people may not come for this kind of government's job program. That demand is slowing down. So these are all some signs which maybe on the rural side also things are not that bad. Other positives, of course, I think one other is if you look at this hotel occupancy rate and air traffic, there was a quick rebound after the pandemic, but right now it seems to have flattened out. So that is a bit of a concern. So this is one of those service sectors which got affected very badly by the pandemic, and you would expect that there's more scope for growth there, but at least there it seems to have flattened out for now. The other positive, of course, for Indian companies and the economy in general is commodity prices cooling off globally. That should mean that companies' margins should actually improve, and that is again a positive for GDP growth. Now, why is export so important? I mean, as a growth driver, obviously, arithmetically it contributes to growth, but also they have a very strong correlation with manufacturing growth and capex growth. So if your export growth is strong, it kind of leads investment growth, particularly in manufacturing. And therefore, that is one of the worries going forward, that globally, if you're going to get into a slowdown, and of course in US, I think there is a reasonable expectation that next year there will be a mild recession. There's going to be a global recession as well, most likely. If that is the case and your external demand slows down, then it has a knock-on effect on your manufacturing demand, on your manufacturing growth, and on investment growth. So that is one of the headwinds for Indian economy going into next year. So your domestic consumption might still be reasonably strong, particularly on the services side, but your exports could be weaker, and that can have a knock-on effect on investment. Now, of course, the government is trying to do something about it. So one of the things which they've kind of launched is the PLI scheme. This is a production linked incentive scheme for different sectors. So essentially, government kind of gives a subsidy to companies to produce. So they are not giving a subsidy to export because that has been contravention to WTO norms. So you just give a subsidy for production, and obviously this will be a lot of these companies which set up base in India, they produce and then they export. So obviously one success area has been on the mobile phone side. So if you can see that how our imports have actually shrunk there and our exports have gone up. So a number of such sectors have been identified. I think one of the sectors which is not here is semiconductors. I think even there we saw news items recently that some companies have been identified and they are setting up plants in India. So this, if it does succeed, it has a potential to kind of give a huge fillip to exports. And of course, this is happening because I think a lot of companies are looking to diversify away from China, right? So that is, I think, the geopolitical side. That is what is aiding this whole push from the government. So a lot of companies are looking at a China plus one or a more diversified supply chain. It's a fallout of both the US-China trade spat as well as the COVID. So companies want to have more diversified or more reliable supply chains. So India could be one of the beneficiaries of that. Of course, this is all very structural. In the short term, there will be some headwinds if export demand does slow down. But over a medium term, again, this seems like a very promising move by the government, and that should pay off. Okay, this is now shifting to on government finances. Again, tax growth has been very strong. Both the center and states, they actually underestimated the tax growth. Compared to that, the actual growth has been very strong, and one of the areas where it's been strong is corporate taxes. And I guess that is due to the nature of the recovery also. So this recovery, not just in India, everywhere, I think it's been led by profits. And that means the corporate tax numbers have been very strong. So if you look at the taxes to GDP as a ratio, that gives a good idea. So the estimate for that is it will be the strongest since FY19. So obviously post FY19, there was a corporate tax cut and then you had a COVID. So the tax collections actually slowed down, but we seem to have fully recovered from that. On the spending side, of course, this is the tax numbers are good, but on the spending side also things might be slipping compared to the budget estimates. So one of the areas is subsidies. I think I did touch upon earlier when talking about food prices. So it's not just food, even fertilizers. So again, when Russia invaded Ukraine, your fertilizer prices shot up globally, which meant that the government had to step in and say that they will kind of bear the extra cost. To make sure that the fertilizer access is there and usage of fertilizers doesn't go down in India. And of course, food subsidies, government has been distributing free food grains to below poverty households. So these numbers have actually really gone up quite sharply this year compared to last year. Even the allocation for MNREGS is seen to be higher than budget. Again, this is one area where they always seem to be underestimating. So both on the revenue and on the expenditure side, there is a tendency to underestimate during budgets. So this is, I don't want to go into numbers. I think the main thing is your receipts are going to be much higher than the budget. So nearly 2 trillion higher is the total receipts compared to the budget, but the expenditure is again 3 trillion higher. So net your fiscal deficit is around 1 trillion higher than what the center estimated. But as a percent of GDP, we are saying it's going to be the same. That's because the nominal GDP is also going to be higher. So again, nominal GDP growth was estimated during budget, at the time of the budget as around 11.5%. Probably we'll end up with something closer to 17% nominal growth now. So as a percent of GDP, your fiscal deficit to GDP is going to remain the same as in the budget. But in absolute terms, the deficit will be higher, which means there could be some extra borrowing in the bond market later in the financial year. Now, how are states doing? Actually, states are actually doing a much better job for whatever reason. I mean, it may not be fully by design, but in terms of their, obviously their revenue growth has also been strong, but their spending growth has been quite slow. So on both on the capex and the revenue side. So their fiscal deficit is running at a much lower level compared to what they had budgeted. So basically, we think states will actually end up borrowing lower than what they budgeted. So that is the offset basically. Center is going to borrow a bit more, but states are going to borrow much lower amount. So net, if you put together those two numbers, the borrowing number will be lower than what was anticipated at the time of the budget. And probably that is kind of reflected in the bond market moves, right? So your short-term rates have gone up quite sharply. RBI has been hiking rates, but still the bond market has been more or less well behaved. And this is one of the reasons for that. Okay, so that's kind of sum it up. I think this is basically an index which I think Arvind Subramanian wrote about in one of his articles. So we called it a macroeconomic imbalance index. So it is essentially you're summing up your gross fiscal deficit, current account deficit, and CPI inflation, all in percentage terms, to see how vulnerable an economy is. So obviously India's number is looking better. Again, if you go back to the period FY 10 to 13, right, the post-GFC crisis period, the numbers were really bad. Compared to that, we are better now. So I guess that is the good news. But the bad news is if you look across, whether with emerging economies or with developed countries, wherever you look, our number is by far the worst. So much so even UK is looking to be slightly better. Now UK is a basket case, we all know that. But our numbers are looking slightly worse than UK also, and US of course, which is grappling with high inflation. So this is basically, I guess this is in a nutshell the challenge the economy or the country is facing today. So because of your high energy and commodity prices, I think trying to ensure macro resilience is very, very difficult. And that obviously has an impact on your growth and other things, right? So obviously, if the effort is always to create those buffers for macro resilience, then that has to come at the cost of something. So you hike interest rates, you spend reserves and tighten liquidity, and maybe over a period of time on the fiscal policy also you might have to tighten. So all this has an effect on growth. So this is something to keep in mind that over the medium term, even if you're positive, things are looking good, and maybe I will touch upon that. I didn't put this in the presentation. So I think pre-pandemic, probably India went through a lot of challenges. There was a GST introduction, which I think really led to businesses making a lot of adjustments. There was a huge period of banking sector problems, right? So there was an NPA problem which had to be addressed, and then there was non-banks also went through those problems. So a lot of that is behind us. So now bank balance sheets look very, very strong. Credit growth is quite strong now. GST seems to have stabilized. So if you look at the GST numbers, the growth is very good. So and capacity utilization is something I mentioned. So for a long period, I think the industry was grappling with excess capacity. That is no longer the case now. And of course, geopolitics is also in our favor, like I said, because of this China plus one kind of strategy which companies are adopting, global companies are adopting. It is a positive for India. They will look to India to set up their bases. So a lot of these structural positives are there, but to navigate that or to reach that, I think we have to navigate through this challenge of high energy prices and energy access. And of course, we have to improve our macro fundamentals. So that is actually basically the challenge. So the opportunity is there, but in the short term, I think the challenges are also there. So to sum up, I guess the conclusion is you cannot escape from a synchronous global cycle. So the global slowdown, which is already kind of starting, probably will have a peak impact next year. So as long as your current account deficit is very wide and you're burning forex reserves to manage rupee, it's going to be very difficult to exert policy independence. US rates should rise by another 125 basis points over the next 2 meetings. That is a minimum. There could be subsequent hikes next year also. So which means RBI and MPC will have to hike rates in India also. Again, this quantum of hikes will be dependent on what the Fed language is in November and behavior of forex markets. So the Fed continues to sound hawkish in November and dollar continues to strengthen. Then that will put more pressure on EM currencies, and therefore RBI will have to kind of, maybe they'll have to hike by more. So purely if I look at domestic growth concerns, and the fact that we all believe that inflation is going to come off next year, that is RBI's own forecast as well, it means that they should slow down the pace of hikes. I think they should only hike by 35 basis points in the next meeting in December and another 25 in February and stop at that. But it may not be in their hands, so it's not in their control. If currency continues to be under pressure, they might be forced to hike by 50 bips in the next meeting and maybe another 35 in the meeting after that. So we think the repo rate should peak at 6.5, but maybe it goes to 6.75 or 7 also. On the fiscal side, again, fiscal deficit at 6.4%, that should be okay. But some extra borrowing could be there, but states borrowing will be lower. So more or less, I think from the bond market point of view, it doesn't look that bad. And that is one of the reasons why bond yields have been well behaved. But still, I think the most likely scenario is there could be still a steady drift higher. And remember, we are saying that short-end rates are going up more. So obviously, which means that the long-end rates will also go up, not to the same extent, but to some extent. So 10-year rate should end up higher than 7.5. On rupee, again, RBI has allowed a reset. So for a long time, I think till August, they were trying to, till into September also, they were trying to defend, or at least the perception was they were trying to defend 80 rupees to a dollar, and then they let it go. So we expect the currency to, it's a slightly wide range, but probably 82 to 85 is the range. The reason is the pressure on EM currencies in general, because of the US rates, is going to be very high. And especially in India's case, like we discussed, I think the current account picture doesn't look very good for India. So rupee will continue to be under pressure. So only that concludes the presentation.
Yeah, thanks, Prasanna. Congratulate you on a very, very comprehensive presentation. It also takes away some of the commonly held perceptions that we had, particularly in the media. We get to hear about a lot about India getting decoupled, and also I think a comparison perhaps may not be exactly the right thing to do at this point, but to the 2013 happening, and due to the taper tantrum and the external vulnerability that we showed, and considering that India's markets largely are, as you put it, well behaved on most parts. So what do you think? I mean, do you think India is in a much better position than it was ever before? And is it because largely of the policy decisions of both the central government and the central bank?
Hello. Yeah, so I think a couple of things are different this time. I think one is I would give a lot of credit to RBI. So during the pandemic, I think we saw a lot of those inflows coming into India, particularly on the portfolio, equity portfolio inflows. I think they were very sure that they didn't want the currency to appreciate, because always when inflows come, there is a choice between allowing the currency to appreciate or basically buying out all the dollars and making sure the currency doesn't appreciate, and each has its own pros and cons. But I think RBI was very particular that they will not allow too much currency appreciation. I think they built up a huge war chest during the pandemic, and that is kind of standing us in a good stead now. So that is one difference. I think pre-2013, there was a period when RBI had a very hands-off approach to currency, and that kind of cost us in that period. We didn't have reserves to burn. The second is, I think what is different is that I think this is very much a global problem. So the US is hiking rates, and every single country is facing this problem, including Europe and UK, including the developed countries. I mean, even Japan also. Of course, in Japan's case, it doesn't matter to them because their inflation is low. But generally, every currency is under attack. In 2013, that was not the case. Only around 5 countries or 5 currencies were under attack, and India was one of them. So this time, I would say India is not being singled out. It is just part of a global phenomenon. So that is also different.
Yeah, you mentioned about the currency behavior and how it's much more orderly than it was in 2013, partly because of the war chest that India had built up. But also, I think there's a feeling that perhaps India, in trying to defend the currency at a level that you pointed out about around 80, was it trying to play out its hand a little bit prematurely, in a sense that, perhaps because the data indicated that the inflation was not peaking out, increasingly the central bank, US particularly Fed, was getting more hawkish. So do you think there would have been, if RBI would have been better off in terms of waiting before playing out its hand on that?
I think it's fair to say that. So probably I would say that it's not just RBI. I think obviously first the Fed underestimated the level of or the extent of inflation problem in US. But then when they turned around and then they started hiking, I think a lot of people underestimated the Fed's ability or willingness to hike rates and basically subject the US economy to some sort of pain. So I think the feeling always was that if asset markets correct, particularly if US equity is correct, and US housing also is correcting now, the mortgage rates are very high in US. If these kind of data points come up, the Fed will relent. That was the feeling I think in the investment community also a lot of people had, and probably RBI also shared some of those feelings, and they thought that the hikes will not go to this extent. And you can say that maybe they erred in that, but I guess it's something which, like I said, everyone did it. But I think they changed course in September. I think after the September FOMC meeting, when they saw the new dot plot and the language of Fed, I think they realized that this is kind of a losing proposition if you continue to defend like that, and that's when they let it go. So I guess you can say that probably after giving this sense of calm for a period and then suddenly letting it go, maybe that was a bit of a policy faux pas, but I guess it happens. So I think by and large they've done a good job.
Okay, so let me just pivot onto the domestic front at this point, and again bringing out a data point from your slide in the sanguine nature of the high frequency indicators. But then most of the high frequency indicators are built around the nominal data rather than the real data. Do you think there's some learning there in the sense that let's not get carried away by this data, because in any case many of them are projecting or downsizing the growth that India will have for the next 2 years. Particularly I think very recently IMF did, before that World Bank did, and an outlier coming from a research agency almost to projecting next year's growth at 5.2 or something. So where do you see that? How much seriously we should take these high frequency indicators?
No, that's right. So I think there is a nominal illusion in the data. So if you look at things like GST and exports and bank credit, for example, it's a nominal growth which kind of shows up there. But there are enough other high frequency. I mean, there is a whole suite of indicators which everyone tracks in the markets. So there are a lot of other things like your auto sales, for example, or petrol diesel consumption again in volume terms. So there are a number of such, the hotel occupancy index which is showed. So there's a lot of other indicators also. So if you look at them in totality also, I think in real terms also, at least currently the growth numbers look good. But if you talk about next year, I agree. I think there are a lot of headwinds gathering. So one is, of course, from the global side, we do know that there will be a recession in US and that will slow down your exports. But there will be a slowdown in India also. So again, that is something, like I mentioned, because the bond market is well behaved. I think even on the banking side, if you look at it, despite all these rate hikes by RBI, for example, I think the bank rates have not gone up. The deposit rates have not gone up. Lending rates have gone up to some extent. But even there, I think the transmission has been very, very slow. So in a very short period of time, you had a lot of rate hikes. It is yet to reflect in the economy. So this will, over a period of time, and a lot of it will happen into next year. That will also come through, and all those interest sensitive sectors, there will be a slowdown. So I think it is right to be worried about next year, and it was a bit of a surprise when RBI, I think in the last meeting, they projected next year growth at 6.5%. We are at somewhere like 6.1, but we know, I mean, we agree that there are downside risks to it. I know that somebody has put up a 5.3. See, normally when you put up these outlier estimates, it's a good gamble, right? If it comes out right, you get all the credit. If it doesn't come out, people anyway they'll forget it. So it's okay. I won't get into it. But yeah, there is a downside risk to next year's growth. There's no doubt about it.
Again, just to get your view on this, I mean, there's been, while in India, you said bond markets are being well behaved, and typically we are also seeing the equity markets also fairly stable in that sense. And whereas the rest of the world has been bleeding. I mean, when you look at US, Hong Kong in particular, I mean, it's at a 9-year low, and Europe is again beginning to look very bad. So when you look at, I mean, is the financial markets in India not really able to figure out where it would be, and there's some confused thing, because from a real economy perspective, we now know that it's not, everything is not hunky-dory. So where do you think, I mean?
So I can talk about the bond market. I mean,
Yeah.
I'm not an expert on equity market, but I think some things are common there. So I think in bond market, what we have seen is that we always used to be a very heavily bank dependent market, right? So ultimately it is the banks who have to come and buy and clear the market. That's been the history of Indian bond market, and that is always is kind of weakness of this market. That has changed over the years now. So the big players now are not the banks. Of course, they continue to be fairly large, but it's your insurers, pension and provident funds, even NPS, for example. So these are the big players now, and they kind of represent a fairly large and steady demand for long end bonds. And that has kind of helped put an anchor or put a stop to how much yields can rise. So that is a change, I think, in the structure of the market itself. And to some extent, that is true in equities also, in a sense, right? Earlier, we used to be more dependent on foreign inflows to set a direction and to support the market. I think that has changed because of the increase in domestic savings and more of those savings getting channeled into all these investment products. So the domestic savings itself gives a large safety buffer or a safety wall for these markets, for equity markets, for example. So in that sense, I think that is basically a transformation of Indian financial markets. So I think, just linking back to your first question, we can say that maybe your financial markets have decoupled, economy has not decoupled. The financial markets have decoupled because the character of the markets have changed.
Okay, great. So the other one is, coming back to the manufacturing sector, and you mentioned about de-risking from China, and the PLI incentives that you brought about. There are quite a few naysayers in that, including the previous RBI governor as well, that this may not work. So where do you see it? I mean, do you see this really? I mean, again, India pivoting from a services oriented to an investment oriented. You mentioned about the budget and increasing capex on the central side. So do you think this is a kind of a long-term structural shift for the Indian economy?
So I think for a country as large as India, and where we have a jobs crisis, right? I mean, as long as I remember, we have been having a jobs crisis, and the way to fix it is to have a big manufacturing base. I think services cannot help us. So despite all the great things done by our IT sector and maybe even our financial services and telecoms and so many other services which have grown enormously, they are not big job creators. You have to have a large manufacturing base to have those jobs. So in that sense, I think it's correct what the government is doing, that you have to push manufacturing. Now, whether this is the way to do it, again, my view is that I think you have to try it. Something like a PLI, when you do it for 10 or 15 sectors, my view is even if it is a success in 4 or 5 sectors, I think it's worth it. So maybe it fails in 5, 6 sectors, 5 sectors pick up, I think it will still be worth it. There is no harm in trying. And we have come to this situation because we know that India has some deficiencies, right, in terms of availability of land, labor, or regulations, or power availability. So many issues are there. So PLI is a way to kind of offset some of those. So you have these deficiencies, you have tried to fix them, beyond a point you couldn't fix them. So you are telling companies, okay, I'm just giving you a direct subsidy in lieu of some of those deficiencies who are going to come and manufacture. I think it's an effort which should be made. We'll see how it plays out, but I wouldn't fault government for trying it.
Yeah, thanks. So one more question, I think let me pick up from the audience. And audience, those who want to ask questions, please use your app and please release so that I can be able to see your questions. But one from the audience here is about negative IIP growth of 1.8% in August. Household savings have, again, these are not really great figures for which would set a base for the good growth in future. So how will you read those figures? I mean, of course, you mentioned about IIP briefly, saying it's typically on a month-on-month basis it's volatile. But having said that,
no, it's fair. So keeping that in mind, still we have to explain why the data is like that. I think one of the weaknesses is in consumer non-durables. So again, it looks like, and I did say that some of the rural indicators are looking good, but this is maybe a counter to that probably rural demand is not as strong. So it is likely that some of it is basically an effect of inflation basically. So your high prices actually kind of depressing demand, and that could happen in these staples basically, right, your FMCG goods. So that production has definitely slowed down. What is doing well in IIP is more on the durable side, things like autos, where earlier because of supply side issues, your production was actually getting affected. Those issues are behind us now. So those are the bright spots. But this is something we have to see, and how the companies themselves respond. So if high prices are actually hitting demand, do companies now try to reduce prices or try to offer discounts? Or do they think that they have to protect their margins? So this is something we have to see. But clearly, this is one area where we can say that inflation is having an effect on demand, a negative effect.
So let me bring the state finances here. I mean, when you're talking about growth and the central government pushing through various ways in terms of asset creation and incentives to manufacturing, you also pointed about
State deficit being in a much better picture, largely because they are not spending as much. So, do you think, I mean, there is some kind of a, a lack of coordination between center and state in this regard, or how do you read this?
So, I think probably because of COVID and post-COVID, I think states have lost a bit of ability or become a bit less efficient in pushing through capex. I would think it's just a temporary phenomenon. It will kind of improve going forward. So this year also they've started slow, but hopefully they will kind of pick up. But the other aspect I think is, by and large, states probably are being a bit more circumspect because I think when COVID hit, there was a lot of worry about revenues, and I think they had a bit of that dispute about GST compensation also with center, right? And you have to remember now the GST compensation period is over. So now states no longer get that compensation. Of course, the GST numbers themselves are very good. So now you don't need a compensation. But like next year, if there is a slowdown and the tax revenues again go down. So I think that worry is there in the states' minds that, and after GST, actually states are not in control of taxation, right? So they basically control your property taxes, petrol, diesel, VAT, and liquor taxes. Nothing else they have. Everything else is kind of either center's taxes or GST is some GST council where nobody has a say. It's all a consensus and all that. So I think there is that bit of circumspection amongst states that they are not masters of the revenue collection, so they have to be a bit careful. I think that definitely is there in the background.
So you mentioned in your last slide about India not being, India cannot escape the geosynchronous cycle. So let me bring about, because the theme today is very aptly titled Regime Shift. And then we have seen some breaking down of the earlier long-term global pact that was there in terms of, there was a energy security that was there at low prices for the Europe largely. And also we saw that, manufacturing largely was kind of outsourced to China, and that led to a lot of low cost and then low inflation as well. So with this kind of breaking down in that chain, so how do you see, and India is particularly vulnerable because neither is it strong in manufacturing nor is it strong in resources. So it's kind of vulnerable on both fronts. So how do you see India playing its strategy out, and do you see India getting increasingly vulnerable over time as this new regime pans out?
Yeah, so I think this is something which was touched upon also because of this China plus one strategy which global MNCs would like to kind of implement, and I guess that is something which is kind of being pushed by the US government also. I think that is where the opportunity is. Of course, I think some other countries have stolen a march. So for example, a country like Vietnam, for example, has done spectacularly well. Mexico is another beneficiary. I think Mexico's advantage is they're just close to US, and therefore locating your supply chains in Mexico makes a lot of sense to US companies. But India will also be in the picture. So I think that is the opportunity, and this PLI is kind of well timed to take advantage of that opportunity. But the flip side is what you mentioned is right. I think energy security and energy access have become big issues, and I guess that is where probably India will have to play its cards well. So obviously you need that kind of access and security through your relationship with Middle East, for example. One other area where I think is, and again this, if you look at India's imports, we have been importing a lot of coal, and that is a bit of a worry because obviously we have our own huge coal reserves. So maybe those are some of the things which the government should look at, right? So where you have your own energy availability, you have to maximize on that potential rather than depending on other countries. And of course, on crude oil and natural gas is something which you don't have a choice. And there, I guess, it's through your bilateral relationships and and trying to ensure that long-term security is there. But yeah, but that is a challenge, and that is basically a challenge for the government on how it manages its external affairs.
Thanks. So let me then point out two last audience questions that I am going to take. One is on there's a question here on why so much focus on the quantum of current account deficit when clearly what matters is the balance of payments. So do you think that's right, and so what your take on that?
Yeah, so I mean, this year we are looking at a balance of payments deficit. I think even next year we are looking at a deficit. So I think the message which I was trying to give was, with such a large current account deficit, it's very difficult, even if your capital flows are reasonably strong, to have a surplus on the BOP. So by and large, with this kind of deficits on the current account, we are looking at BOP either being flat or being in deficit. So that just kind of keeps putting pressure on rupee. So I think that was the point which I was trying to make. Of course, there is nothing wrong in currency depreciating. It's not to say that currency should always be strong. It should be in line with fundamentals. So if your current account deficit is high, then one of the reasons could be that your currency is very strong. So it has to depreciate. So in that sense, it is right only. But just that what it means that your domestic policymakers can lose control. So if your CAD is very high and your BOP is always in deficit, currency is always under pressure, then a lot of the effort and focus will be on firefighting that, and a lot of other decisions will be geared towards that. So I think that is the point which is being sought to be made here, that you will lose control of your own policy if your external accounts are not reasonably stable.
So the last question for the day, for the session is, in a sense that how independent is India's monetary policy, considering that it seems to take a cue from Fed all the time. And also, is this part of a global coordination, or do you find that unlike in 2008, when there was definitely a kind of an explicit coordination, do you see that is lacking here, and that's why things are so chaotic?
Yeah, so no, coordination is lacking. I think that's a fair point. I think post 2008, because it was a once in a century kind of a crisis, there was a lot of coordination. But in terms of how independent it is, I think it's very difficult for any country to kind of, maybe China has achieved it to some extent, I guess. Even there also it's questionable. Essentially, dollar is the reserve currency, and lot of India's, I think more than 80% of India's trade will be invoiced in dollars. So therefore, it's very, very difficult to say that we can have a policy independent of what the US is doing. So, and particularly for emerging markets, and now of course we are seeing even developed markets are struggling, but for emerging markets to have that independence is going to be very difficult. As long as the dollar is a dominant currency of global trade and finance, I think it's difficult to have something independent of the US Fed.
Yeah, thanks, Prasanna. Really, really impressive presentation, and great, and actually it reveals the great depth of knowledge that you bring in, and the kind of data that you showed up in the presentation. I think is really spectacular, and really privileged, learned a lot, and I'm sure the audience has also learned a lot. Audience, please give a big hand to.
Thank you.
Yeah. Pleasure is mine. Thank you. It took 10 extra minutes.
Thank you so much for sharing your insights with us, Mr. Prasanna and Mr. Kalu. That was a reality check for most of us. Now we'll have a short break. We were planning for a 30-minute break, but it will be more like 20 minutes. So we'll join us back at 11:15 sharp for the next session. The next session takes off from where they left on state finances.